Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Jacob Vanderslice, and he is the co-founder of VanWest Partners, and he is a seasoned real estate investor with deep experience in self-storage and residential acquisitions. He has helped oversee more than $375 million deployed into value-add self-storage facilities and the acquisition of over 1,000 residential properties across the United States. Welcome, Jacob.
Thanks for having us on, Gary. Good to be with you.
Great, appreciate it. So give us your background. Kind of what did you do before you kind of got into the real estate investing?
Well, I've been an unemployed real estate hack for almost exactly 20 years now, and a little bit of change. I was in the fire service before that and had a bunch of time on my hands. You only work 10 days a month. And I started dabbling in residential on my days off, doing the tile, doing the drywall, liked it and quit my job. And for better or for worse, I've been in the game ever since, I guess, '06. As you alluded to in the intro, for many years, we did a bunch of residential deals, mainly in Denver, but all over the country. We got into commercial real estate in 13, 14 with some adaptive reuse retail projects, like historic kind of preservation projects around Denver. We did some townhomes, some apartments, some industrial. We've covered a lot of the bases in real estate, and we did our first storage deal back in 15. And at the time, it wasn't really a strategic pivot to a new asset class. It was more, hey, we like this strategy. Let's give it a try. And the first one went okay, so we did another one. And over time, we evolved to being pretty much exclusively a self-storage owner-operator. We have 42 assets. About 3.3 million square feet, just right around 330 million in AUM. And we'll occasionally build and develop new storage facilities, but most of our assets under management are existing facilities we've identified that have some level of operational inefficiency. Their rents are below market, their expenses are above market, but they don't have a website. We'll buy those and we'll plug in and endeavor to operate them more efficiently and grow value by increasing revenue while controlling expenses. So that's what we're up to.
So what was it about real estate that excited you so much that you quit your job and decided to do that full time?
I'm not smart enough to understand publicly traded equities and bonds. And I always like the simple aspect of real estate and that you can quantify it. It's a building. You can look at the building and determine hey, it's in rough shape. It's not rented out. I can see a good path to creating value here by doing X, Y, and Z. And really, all you have to know is two things. And I'm oversimplifying it here egregiously, but you got to know what it's worth when you make it better, and you got to know what it's going to cost you to make it better. And if you can figure out those two things, you can back into what you can pay for it. So that's why I like real estate. Just a simple mind in real estate. Don't get me wrong. There's plenty of complexities and difficulties, especially tax season, which you can appreciate more than anybody. We're recording this a couple of days after the extension deadline, so hopefully we're coming up for air there. But yeah, generally it's a simpler business than a lot of other things out there.
So for business owners and investors who want to now get into this space, what's a good kind of, I'm going to say, entry level project or something to get involved in?
Yeah, if you want exposure to the self-storage industry, you've really got three options to get exposure. One option is you go out and buy a storage facility. Now, takes a lot of money. You got to figure out how to run it. You got to hire people, and you might end up kind of buying yourself a job, and you probably already have a job, so maybe it's not the right fit. Another option to get in the business is to buy stocks of publicly traded self-storage companies like Extra Space, CubeSmart, Public. Um, and you're getting exposure to the space, but you're also getting exposure to the broader market sentiment of what the stock market's doing that week or that month. And maybe the REIT you're invested in has got some great earnings, but the stock market's going down because of what's happening in the Middle East or inflation concerns. And your third option is to invest in a private operator in a private real estate offering, whether it be a fund or a syndication. Um, and in that option, you can get exposure to the asset class. You can get most of the economics, but your entry point's a lot lower. You might only have to, not only, but only have to invest 50 to 100K versus buying a $5 million storage facility.
Sure.
You enjoy the tax benefits, which you would not enjoy if you were buying a REIT stock. Your main downside is obviously you've got a risk of loss, but you've got a lack of liquidity. You can't push a button and sell your interest in a private real estate fund or syndication like you could with a publicly traded stock. Um, and you're stuck in the deal for as long as you're invested in it for, as long as the asset's owned. So you got a lack of liquidity, but you are getting good economics. You're getting the tax benefits that you would as if you went and did the deal yourself, and you've got a lower capital entry point. So those are kind of the three options to get in the business.
Right. So if someone were to choose to give in with private, what I guess what is their exposure? I mean, it's like, okay, you said 50, 100 grand. Say I put 50 grand in. Um, is there a risk that I'm going to have to put more in, or is, my risk just that 50,000 that I put in?
Yeah, generally your risk is limited, which is still material, is limited to your invested capital. Now, in any private real estate fund or single asset syndication, there are typically provisions in the operating agreement where if the deal unexpectedly needs additional equity in some years down the road, you're either obligated to contribute that additional equity, and if you don't, your shares get slightly diluted from those who do. But generally, they're not, if the deal just goes lights out, your exposure is backstopped at your invested capital. Like the bank on that deal is not going to come after your house or your savings accounts. So the downside protection is, again, limited to your invested capital for the most part, other than possible capital calls. And we avoid those.
Gotcha.
Knock on wood. Yeah.
So is this so when if I invest in this, so I'm investing in a partnership, and I'll get a K1 at the end of the year, and that's how I report everything on my taxes.
That's exactly correct. Yeah. So in most private real estate vehicles, you're buying membership interest in the LLC.
Mhm.
And whether that LLC is a fund that owns a collection of assets or an LLC that just owns one specific building, you're in a partnership and you're getting the corresponding tax treatment with a K1. And this time of the year, I'm on a lot of calls explaining K1s, and then I feel like I forget everything I learned that year about K1s when the next year comes up. But if you're investing cash versus a retirement account in a given deal, you're benefiting from the passive losses that depreciation and sometimes operating losses generate. And that's one of the reasons why real estate can be attractive during the hold period is ideally you're getting positive distributions from cash flow, but you're not triggering any taxable income because of depreciation. So your K1, for example, might show you got $8,000 in distributions, but your passive loss was in old box two, which you're more than familiar with than I am,
Yeah.
might show minus $2,000, right?
Mhm.
And you can use those passive losses in that K1 to offset other passive gains in your portfolio that you might have incurred during that tax year. So there are some tax advantages, and yes, it's a partnership, pass-through entity, and the tax form is not a 1099 or a W-2, it's a K1.
Gotcha. Um, what from a getting into this, I mean, obviously there's in all of our fields of business, there's the bad actors that are out there. If somebody's looking to get into this, what's the best way to go about finding out, who the people are that are doing this right and who are the people that aren't doing it right, so they invest in the right group. When they do
Yeah.
this.
Yeah. I'm obviously biased when I say this, but I really believe that diversifying into private real estate should be a piece of your wealth creation
Mhm.
strategy, right? You've got your stocks, you got your bonds, you've got the business you might own and operate, you got your retirement accounts. But an allocation to private real estate, I think, not too much, but is a prudent move to, defend against inflation and have a hard asset in your balance sheet. Um, we have over 450 unique investors across our portfolio, and I've spent a lot of time talking to all of them over the years. I know what they look for, what they're concerned about, what their goals are, and it varies from person to person. But one mistake investors often make when they're evaluating potentially partnering with a sponsor in a private real estate offering is just not asking necessarily the right questions. So too often they'll ask me, or ask anybody else for that matter, what's my return going to be on this deal, right? What's my IRR and my multiple going to be? What's my cash flow? What's the hold period? Those are all good questions to ask, but I think what a more important question to ask is, tell me how I lose on this deal. Tell me about the series of events that need to take place where I don't get all my money back at the end of the deal. What needs to happen there? And I think people don't spend enough time getting to know the sponsor. They spend more time on the asset class and the strategy and less so on the people. And
Mhm.
the people are who are executing for you. The management team, all the teammates underneath the management team are who you're relying on to go out and deliver the return that they targeted. And good questions to ask a sponsor, I think, are less so like, hey, tell me about your best deals and how this one's going to be like that. And more so, tell me about your failures, right? Tell me about what hasn't worked. Give me a recent case study in this kind of new real estate era, going back to call it late 22 when interest rates had gone up a bunch and the market shifted, inflation took off. What's something you round tripped in that time period and tell me what the outcome was. And if it was a bad outcome, how did you handle it, right? What happened? Why didn't it work out like you thought it would? And I think in this kind of higher risk environment with a lot of uncertainty, people need to be more focused on the downside and the risk more so than they should be focused on the potential upside.
Yeah.
So asking questions like, tell me what went wrong over your career are, I think, more prudent and more important to ask than tell me about all your home runs you hit back in 2021 when everybody else was hitting
Yeah.
the same home runs at the same time, right?
Right. Yeah. I think that I think it's one of those things too that when people look at, again, from my side, the tax side of things, they're looking at that. They're not looking at, you know, again, like you're saying, who's the person who's actually operating this for you? Who do they have in their stable to make sure that everything is going right, and also to help reduce that risk that you've taken as you've gotten into these things. Um, the from the investor side, let's take the next step. Okay, I got into some self-storage stuff. Now I want to get into some other, maybe real estate syndication or something like that. How do people kind of take that next step? I mean, because believe it, I mean, I believe that it's a smaller community than people think. Yes, there's a bunch of people that are investing in real estate, but I think the syndication and self-storage and things like that, it's smaller. There's a limited number of people that uh, are in this. So how do they take that next step?
Well, in between kind of concluding you might want to do this to actually signing documents and deploying capital with a sponsor, it's always good to kind of understand some of the private equity real estate jargon terms that are out there, and we'll spin through a few of those briefly. First and foremost, I think most importantly is a term called the waterfall, and it's a cute term to describe basically the math on how distributions are calculated and treated to investors. And depending on the offering, there's different types of tiering in the waterfall. And typically, what you'll see first is something called preferred return. And then after that, there's generally a split with the investor and the sponsor, and that very much, especially these days, should be in favor of the investors by orders of magnitude.
Right.
To touch on preferred return for a moment, or PREF, you sometimes hear it characterized. Preferred return is designed to get investors up to a certain per annum return before anything else happens. Our offerings have historically been 8 or 9%. So we got to pay you an 8 or 9 before any other economics kick in. Um, so understanding the waterfall and whether that's market clearing, and even those of us who had no idea what AI was a couple years ago are getting in Chat GPT for basic stuff these days. So throw in Chat GPT like, hey, what's a market clearing waterfall? Now, if you see a deal where somebody's offering a 5% preferred return and a 50-50 split, you should probably not do that deal because that's not market clearing. That is not an investor-friendly waterfall. And capital is difficult to raise these days. Investors are skittish, and waterfalls have very much gone in favor of investors and less in favor of sponsors the last 2 or 3 years. So understanding what a waterfall is, what that means, and then understanding a few kind of basic return metrics that everybody uses to quote the given targeted return of an investment. One of those is called IRR, or internal rate of return. This is one that I personally hate, but we still quantify it. We still live and die by it. IRR is basically a return calculation based on a time-weighted series of cash flows. So IRR accounts for time. Now, if you wire me money today and I wire you your money back plus a tiny bit of profit tomorrow, your IRR is going to be through the roof, but your
Right.
multiple, which is the second metric that we speak to, is not going to be attractive. So multiple on invested capital purely means how much profit are you targeted to realize out of the investment as a percentage of your original invested capital. So if you're investing 100K, targeting getting 200 back, that's a 2x. 100 in, 150 back is a 1.5. So if I tell you, Gary, I could probably get you a 2x multiple, you might say, oh, it sounds like a good deal. I'll invest in that. If I tell you I could probably get you a 2x multiple over 20 years,
Yeah.
right? That's not very attractive.
Right.
That's where IRR comes in. So when you're looking at different offerings, you want to understand at a basic level what those two metrics, IRR and multiple, mean. And you want to see the deal offer or target a reasonable blend of those two, right? A market clearing IRR, but also a market clearing multiple. And you can see deals that have really low multiples but high IRRs, and vice versa. If you have a 3x multiple, but it's over 15 years, still not a bad return, but that IRR is probably going to struggle to get north of a 10 because of that additional elapsed time.
Right.
So the waterfall, preferred return, the split that's the sponsor is taking on the back end versus investors, and then understanding not only what the IRR and multiple targets are, but also understanding what assumptions are driving those targeted returns. If those assumptions, you have to be a real estate finance expert, you can just Google a lot of this, but if those assumptions suggest that, hey, if everything goes perfectly, which it never, ever does, we're targeting a 15 IRR and a 2x multiple, right? You want to see a good downside story and a kind of a base case story. Like, hey, there's upside on that return target, but if it doesn't go well, there's still an okay return coming out. It may not be a 15, maybe it's 12. But just at a basic level, understanding the assumptions that are driving those return targets. Once you get through all that, you like the sponsor, you like their strategy, your next steps are basically to sign something called subscription documents. You put in your details, like either your tax ID if you're going through an LLC or an entity, or your social if you're investing personally. You read these, you sign them, the sponsor countersigns, you wire money, and then you're partners, and you've got a piece of a private real estate deal.
So, Jacob, just going through what you just talked through, a lot of our listeners are probably like, "Holy crap, that's a lot of stuff to know." Where would you suggest somebody go to start educating themselves? Who to listen to, what to read, what would your kind of, your investing in this stuff for dummies area be to go to listen to get some more education on this?
Yeah, there's plenty of, I don't say this with a negative connotation necessarily, but there's plenty of gurus out there
Mhm.
who teach people about how to evaluate private real estate deals. There's different forums online. Just Google a private real estate investing forum. People will kind of post ideas about sponsors and what's working, what's not. And maybe I'm leaning on this crutch too much, but I'll say it again. Pop into ChatGPT. Like explain what IRR means to me through the
Right,
context of a private real estate investment. Explain what multiple means through the context of private real estate investment. Give me 5 questions to ask a sponsor. These models are getting smarter by the month.
yeah,
Using them a lot in our business. I'm not trying to get on an AI tangent here. I know everyone's talking about it. We'll not belabor it any further. But that's a great resource to just punch in. It's almost like getting a real estate finance expert for free or close to free.
right,
You can ask any question to, and it gives you an answer in a way you can understand it.
right. So, we've covered a lot of stuff. I mean, we could keep going because I think that this is something more and more people are trying to get involved with it, and I think it's something people need to educate themselves on before they jump in. What questions have I not asked you wish I had?
You covered a lot of the bases. Sometimes I'll get a question like, what advice would you give investors out there right now? And not that I'm one to dispense advice, but my response is always take a risk. Nothing is risk-free. And
Right.
if you've been thinking about, yeah, man, I'm making money in my business, but I got a lot of equity tied up in my business. What if something changes? I need to diversify. The easiest thing in the world to do is nothing, right? Go out there, find an asset class you like, maybe find an offering that's kind of near where you live so you can check on it. But most importantly, find a sponsor you like. But creating wealth in real estate takes a lot of time. And if you're
Hmm.
not deploying capital and taking a risk, you're missing out on that time component. And there's some distress in the market, and it's never a good time to buy or a bad time to buy necessarily, but there's deals that lack risk-adjusted returns, and there's deals that have good risk-adjusted returns. And we're seeing more of the latter lately. And I think it's a good time to invest. Just protect the downside and make sure you're partnering with someone you trust that's been around the block.
Right. So, Jacob, if people like what they hear, how can they reach out to you? How can they learn more about you and VanWest Partners?
Yeah, always love to talk shop about real estate. In case you haven't noticed, you can email me, Jacob at vanwestpartners.com. Hit me on LinkedIn, Jacob Vanderslice, or you can go to our website, vanwestpartners.com.
Great. Really appreciate your time today, Jacob. Enjoyed our talk.
Thanks for having us on, Gary. Let's do it again.
Yes. Thank you. This week, our guest was Jacob Van Slice with VanWest Partners, and I'll see you guys next week.